Okay, we are live for Momentum Monday on Monday, March 29. Holy cow, we're spring, and in most markets where we are, the weather has been pretty decent as of late. Hopefully, those in the middle of the country have worked through all the storms that passed through there Friday and Saturday. Pretty nasty in Nashville and surrounding areas. We have a very special treat. Our good friend and partner Barry Habib will join us here in a couple of minutes, and there he is. He's going to join us in a minute. I'm going to give it a few more times because we're going to have a big crowd here today. I want to make sure everybody gets in that wants to get in. But I'm going to tell you, I got to do this with the booklet here. Hang on. How do I? There we go. Money in the streets, and we're going to find out if there's still money in the streets here from Barry in a minute. But for a few lucky participants that asked some questions throughout the show today, I've got a whole bunch of these signed books that we're going to pass out and share with all of you. So with that said, let's get started with today's not readiness briefing. We're going for Momentum Monday today, and we are using Zoom. And in the event we get Zoom bombed, Jessica will be kind enough to shut this down for us. Questions, as I said, are welcome. And for those, a select few will get a signed autographed book of Money in the Streets that Barry's got behind him. So welcome in to our very good friend and unbelievable partner we have, Barry Habib. Great to see you. Thank you so much for joining us in these crazy times. We thought 2021 was going to be a whole lot better and different than 2020, and it's starting out a little chaotic for us all. What's going on?
You know, there's a lot of good there. There's a lot of good things going on. So first of all, Craig, thank you. Appreciate you and your friendship, and it's great to see you and Doug and Ron, Mark, and both Rons, actually, I should say. And Jessica, thanks for doing all the stuff that makes it easy for us and making us all look good on here. So appreciate you. And all my friends at AmeriFirst, it's so great to be with you once again. You know, I've enjoyed times where we've had some calls together. We went through some hairy moments together in 2020. We came through it okay, maybe better than okay, hopefully. Hopefully you and your families are all good. But now we're in 2021, and we're coming up to the close of the first quarter already. I don't know where the heck the time goes, but it just seems like it just accelerates each month, each quarter, each day. But what we want to try and do now is make sure that 2020 isn't something we look back on and say, oh, well, it was a good ride while it lasted. 2021 can be pretty amazing. When I was originating loans, when there was a super hot market, it was great. We all enjoyed it. But sometimes I couldn't help but feel this way, that, man, I felt that I put so much effort and work in to improving my skill set, and I didn't know that it was shining as bright as it really should have, because it seemed like everybody was doing well, even some people that were less experienced or maybe less knowledgeable, that didn't put in as much effort, and they were doing extremely well. But it's times like this where things change a little bit, that the great company that you're with, the great leadership that you're with, all the effort that you put in, that's when you can really shine. And right now you can really shine. It can be great. Now, it's not without points of friction. The purchase market, it's hot, but it's difficult. It's something that we always have to sharpen our skill set in order to remove points of friction. The refinance environment, there's still a lot of people that can benefit, but they either feel butthurt or they're in a position where they're waiting for rates to cycle back down. And we have different areas that we need to focus on, but we can still do amazing numbers in this environment. So let's get started. It's great to be with you because I think you guys understand a lot of the concepts that are out there. And I want to talk to you about where interest rates are, where they're heading, and how we can win in this environment and win in a big, big, big way. So I'm going to share my screen. Let's start there. And I'm going to start by looking at where the interest rate environment is right now. So you can see we're down 11 basis points right now on mortgage-backed securities. We're not really in a position to worry yet about a reprice, but I'm not loving the way the market is. Look at the 10-year up to 171. Now, you guys hopefully are watching the daily updates every day, because we did say, as we look at the 10-year here, it looks like we're moving up towards 175. And look, if you remember on Thursday, when everybody thought, okay, the market's doing well, we told you guys to lock in on Thursday. Why? because we said we tried to get past 160. We couldn't get below 160. And because of that, we thought that we'd probably wind up drifting up towards 175. And everybody was on CNBC saying, oh, rates are going lower. You now have the great David Tepper saying, oh, rates are going to go lower and this and that. It seemed like we were the only guys that disagreed with it. But sure enough, things have gone now from 160, as you can see, to 1713. And I think that there's a good probability that we gravitate towards 175. Now, let's hope we stay in this range, because the news I'm going to start off with, and I'm going to explain why, is that over the next few months, you're going to see rates go higher still. I want to talk with you about that, and I want to tell you about what strategies to employ so that you can continue to win. We take a look at mortgage-backed securities. Now, mortgage bonds, this is where it's kind of gotten ugly here in pricing, in the pricing that we've lost. Now, back, if we go back to December, we did a rate lock alert in December that was right at the top of the market. We didn't lock for 5 weeks, and then we did one on January 5th, again, right at the all-time highs, and then right here back in January 28th at the all-time highs. And then sure enough, as prices were declining, you see many, many rate alerts that we've done. Now, here's where we thought we'd kind of land at a floor. We didn't quite land at a floor until the next day when that 7-year note auction surprised us. But of course, we were pretty well protected all the way down. And then we couldn't hold this level here, and we've gravitated now towards this floor. And as you can see today, we're breaking underneath this floor. I don't like the way this looks. It looks to me that we are more than likely going to get back down towards this floor. So I think we're going to lose some pricing here. And you can see it's already started. So it wouldn't surprise me if sometime today, maybe sometime during this call, we're going to have to think about doing an alert to lock in. I don't really like the way the market is trading at all right now. But let's take a quick look at where we are and some of the factors that are surrounding us. So first of all, the stock market, it is pricey, but it is being held up by a lot of this stimulus that's out there, because a lot of it's finding its way into the stock market. Deutsche Bank and Goldman Sachs did studies that say 60% of the stimulus checks are finding its way into the stock market. Now, look, I don't want to get philosophical on this, but my question is should we be doing stimulus so that people could play the stock market? I'm not so sure that that's what the stimulus is intended for. And look, it's a great idea. I love helping people, but it's not without a cost. The debt that we're getting into is just unbelievable, and that's going to result in much higher taxes for all of us to pay. John Templeton, one of the greatest investors of all time, said that bull markets are born on pessimism, grown on skepticism, mature on optimism, and they die on euphoria. And the market's quite euphoric right now. You've seen us talk about this in the updates. The Citigroup Panic Euphoria Index, a reading above 0.41, says we're in euphoria. And if you look at where we are today, we're way above that. And you could go back to any time we've gotten above 4.1, and it's been very rare, the market's pulled back. And sometimes not only has the stock market pulled back, but it's led to recession. Here we, of course, have the recession here. But our euphoria index is here. Here's where the dot-com bubble burst. Here's where the markets crashed in 2007, 2008. So we're at, we don't even have a measuring stick for the high levels that we're at right now. And we go back to Joe Kennedy, who forecasted the stock market crash when he thought that because the Shoeshine Boy was in the market, that everybody was in the market. People were too euphoric. He thought the stock market was going to crash in 1929, and he was right. And today's version of the Shoeshine Boy is all the people in Robinhood, these inexperienced investors. So do we think the stock market's about to have a major pullback? It's possible, but the euphoria is being maintained by a lot of this stimulus. One thing we do know is that it does wear off. And when the stock market does pull back, chances are you'll see a big improvement in the bond market. Now, the reason why we have to think about the bigger picture and the longer term as well as the shorter term is because the impact debt has. So you all know this, and you guys are a lot smarter than the average mortgage professional out there. We've gone over stuff like this. You know what drives interest rates. What drives interest rates is inflation. Inflation is that driver. We've talked about this before. I've used the example. If you gave me a mortgage, I'm paying you $2,000 a month. You use that $2,000 a month, and it buys a shopping list of goods and services exactly worth $2,000, and you get the same list next month, the month after, but over time, inflation even though it's gentle, it does cause prices to rise, which means that you cannot afford everything on that list anymore. So you have to leave some stuff off. So what's happening is your buying power is being eroded. It's the same $2,000 a month. It's just not buying everything. So you can't do anything about the loan you gave me if inflation starts to rise over time to a faster rate. But what you start thinking about is on the future loans that you're going to do, if your buying power is going to be eroded faster, then what you probably need to think about is offsetting it by starting at a higher perch, which means you have to charge a higher interest rate. And that's why when inflation is either anticipated to rise or starts rising, interest rates go up. So right now we haven't seen the hard numbers of inflation rising. It's all anticipation of it rising, but that's why you've seen mortgage rates move up roughly 0.5%, because we think inflation is about to rise. And we're right, inflation is going to rise. I want to explain it to you in just a minute and its effect on interest rates. So this is all important for us to get, because what drives inflation is economic activity. And debt is like a weight on economic activity. It's just like that family that wants to go out and buy a nice car and they want it now, so they use debt so they can get it now. And when they make the purchase using debt, using credit to make the purchase, it creates a spurt of economic activity. You have the manufacturer, the dealer, and the salesman all make some money from that transaction, and they go out and they create some economic activity, but it wears off pretty quick. And what's left behind is that family now for the next 5 years has $1,000 a month less or so that they can use for economic activity. So it acts as a drag in the long run, spurt and then a drag. And that's what we're seeing right now when we see this push of stimulus creates economic activity, creates inflation. But then as that wears off, now we don't know if there's going to be another infrastructure deal that we see, $3 or $4 trillion, so crazy, right? We don't know if that's going to happen, but without that, over time, it'll wear off. If you remember last year, the CARES Act was in March and April, 2.3 trillion plus 500 billion. It totaled $2.8 trillion, a huge number and a huge spurt of activity. But by October, it wore off. In December, we got 900 billion. In March of this year, this month, we got another 1.9 trillion. Coincidentally, that same 2.8 trillion number again. If we follow the same playbook without additional stimulus, perhaps by October, this wears off. And you should start to see both interest rates cycle down, economic activity slow down, and you should see interest rates move back lower. Now, the caveat here is, do we get a $2 trillion, $3 trillion, $4 trillion infrastructure package for stimulus, and that kicks this down the road a little bit further? But eventually, when it wears off, we're going to see a recession. And that recession is pretty much inevitable. You know, we called the recession when I was with you. We told you that you're going to see a recession in 2020 at the beginning of the year. And sure enough, we got it January 31st before all the lockdowns. And we said that interest rates were going to go lower. And remember, when I remember when I was with you in March of 2019, I said, don't do any loans with upfront MI, take monthly MI to the extent you can, because there's like a 4-year break-even period, and you're not going to have this loan longer than a year or so. And the same thing was with points, and the same thing even with the lowest rate. We said, you know, if you can take a higher rate and have less fees, since there's typically, depending on the specifics, of course, but 3 or 4 year break-even period there, maybe 5-year break-even, you're not going to have this loan for 3 or 4 or 5 years. And that was very good advice. Team, what I'm telling you is the same thing is about to happen. 2022, 2023, you're going to have a recession. You're going to have very, very low rates. And all the loans you're doing today above 3% are going to be refinanced. So you're right now, what you're doing is you're planting the seeds for tomorrow's refinances. All right, let's take a quick look here back at the slides.
Hang on. Before you do that, I just wanted to show something here. Well, no, let me grab something here, Barry. I'm going to tell me what this is all about.
Oh, wow. Yeah. So thank you. So I did a couple of weeks ago, I did get notice that I won the Crystal Ball Award again. Nobody ever won it twice, but I now have won it 3 times for 2019 and for 2020 for having the most accurate real estate forecasts in the country. There's 150 economists And some of them are very big. You know, you've got Goldman Sachs, Wells Fargo, Morgan Stanley, and some smaller folks. But I was extremely, extremely honored that that we wanted. And listen, I give the credit to my team, and I give the credit to you guys too, because you guys have helped by every time I came out to talk with you and telling me what your local real estate market conditions are. It really helped us get a jump on and get a more accurate read. So we all share in this together. This is something that belongs to all of us, because if it wasn't for you, there's no way that we could have come up with the forecasts that we did. So thank you, Craig. That's
Yeah,
great.
congratulations.
Well, thank you, thank you. It's a big honor for all of us, and I appreciate you acknowledging that. Thank you so much, brother. So let's go back and take a look here. And we talked about debt slowing growth. How much debt do we have? Well, right now we've got 28 on its way to 30 trillion. Who knows if it's going to be higher than that? And that's going to slow growth down, because you have to raise taxes. That's going to slow growth. And you know, when you talk about trillions, we often are immune to it, because the word trillion has lost it's just shock and awe. But it really is an enormous number. If you said, okay, spend $1 million a day, every day, 7 days a week, it would take you 2,700 years of spending $1 million a day, every day, 7 days a week to reach 1 trillion. You would have had to have started in 700 BC. You still wouldn't get to $1 trillion today. And the reason that we look at this is because, as I mentioned to you, that debt, we use the example of the family now having $1,000 a month less, but an economy feels the same way. In the United States, you go back to the 1950s, when our debt in pink goes down, there's more money for economic activity. It generates growth, it generates inflation, and in turn, that inflation pushes rates higher. As our debt rises, less economic activity because there's less money, lower inflation, and in turn, interest rates decline. Debt goes up, rates drop. And it's the same everywhere in the world. It's the same in Germany. It's the same in China. It's the same in France. You can see it's the same in Japan. It's the same in the UK. It's the same in Italy. So this is everywhere in the world, same story. We get the exact same picture everywhere you go. So we know that this debt is going to cause rates to decline. We know that there's likely a recession over the next couple of years that we will be seeing, and that means lower interest rates for us. Now, rates are going to remain attractive, but it's a rocky road ahead. And here's the thing, is that when we look at this rocky road ahead, we know that the administration has increased the supply of treasuries to be sold, because we don't have this money where we have to borrow it in order to write all these stimulus checks out, which means that people like you have to buy treasuries. And maybe you're not realizing that you're buying them directly, but if you have mutual funds, 401ks, IRAs, insurance policies, some of your money is invested in treasuries or in mortgage-backed securities. So we are having to be incented to buy this paper with a higher interest rate, due to the fact that there just isn't enough demand at those lower levels of interest rates to sop up all of this. So rates are going up because of more supply that's out there, as well as the inflationary fears that people are thinking. So rates are likely to bump higher before they resume a downtrend, and inflation fears are pushing interest rates up. So we talked a lot about inflation. Let's understand how inflation works. Now, the first thing that I want you to really understand is that your customer's psychology here is one where they can act a little butthurt, they can act like spoiled brats. Look, everybody wants the lowest rate out there, you know, and they're going to be like, oh no, I want 2 3/4, you know. If they were saving, I don't know, $350 a month at 2 3/4, and maybe today they could save $275 a month, it doesn't mean it's a bad deal. They shouldn't be spoiled brats about this. We have to calmly explain to them that if you're waiting for it to get back to 2 3/4, there's no guarantee. Might get back there. In fact, we think that if there's a recession, who knows, we could approach those levels. We think they will cycle back down. But two things you should know. One is they're going to get worse before they get better because of inflation. And the other is that if it still makes sense to save $275 a month every month this right now, even with rates at 3 1/4, the reason why you should do it is because even if you're right, but it takes 10 months to get there or 11 months to get there, that's like $3,000 that you would have lost by not taking action today. Take action today, save that money. If rates don't come back down, you really were smart. If rates do come back down, then that incremental $75 a month would take a grand total of like 4 to 5 years before you got just back to even. So do you really want to wait 4 or 5 years on a potential to maybe start saving an extra $75 a month 5 years from now and beyond? Or would you rather start saving the for sure $275 a month now? You sometimes have to talk them off of their emotional outrage of, not getting that lowest rate in history, and remind them that it still makes good common sense to do this. And the reason why we think rates are going to go higher is because inflation's about to rise. Now, when we talk about the rate of inflation, we like to look at the core rate. That strips out food and energy. So you got the headline and then you got the core rate. And if you look at the consumer price index, that's pretty widely viewed as a good inflation gauge. The core rate strips out food and energy. And then some people will say, well, wait, I need food and I need energy. Why are you stripping them out? Because the Fed wants to look at things that they can influence. The Fed can't influence if a tanker gets stuck in the Suez Canal, causing oil prices to rise with monetary policy. The Fed, with monetary policy, can't influence if there's a drought. So they look at the core rate because these are things that the Fed can influence. And when we take a look at that, the rate of inflation on a year-over-year basis is 1.3%. Now, how do we get to 1.3%? Well, you look at each month's inflation for the most recent 12 months, and you total them all up together, and it totals 1.3%. But what you'll notice is that the most recent number is February of 2021, and it goes all the way back to March of 2020. Now, in the second week of April, we're going to get the number for March of 2021. And when we get it, we're going to replace March of 2020. So let's make an assumption, because you have to make an assumption. We got to put a stake in the ground and build a model. And I think it might be a little conservative, but I think we'll see probably at least 0.2% per month inflation, especially with all the stimulus going on. So when we take a look at the number that we're going to get in the second week of April, which will give us the reading for March of 2021, we're going to replace March of 2020. We're going to replace 0 with positive 0.2. So that means this number is going to go from 1.3, and you could do the math. It'll go up 0.2 to 1.5. Not too bad. But then look what's going to happen the second week of May when we get April of 2021's inflation and we replace April of 2020. That's going to be going from negative 0.4 to positive 0.2. You can do the math. That's going to start to raise a lot of eyebrows when inflation goes to 2.1% year over year from its current 1.3. And then it gets worse. In May, the inflation that'll be replaced, now we're going to get the second week of June, will push it to 2.4%. So let's review. Right now, inflation is 1.3, and mortgage rates are starting to rise based upon the anticipation of inflation, but they haven't risen as much as inflation is going to rise just yet. So here you see in April, it'll go to 1.5, in May, 2.1, and in the summer, you're going to be at 2.4. So if you're offering a mortgage rate today at 3.25 with 1.3% inflation, I promise you, you will not be offering a mortgage at 3.25 with 2.4% inflation. You more than likely will be closer to 3.75. Could it be a little bit higher, a little bit lower? Sure. And there's other factors to contemplate, but it's not going to be 3.25. It'll be higher. And that's why you need to tell your customers to get off their emotional ride here, stop crying, and take advantage of what they have. Look, people always make the wrong comparison. They compare what they could have had to the rate today. But the fact of the matter is you just can't get what you could have had. Your true choice is the rate today with what the rate will be in the future. So you can either pick today's rate and choose that over the rate in the future, or you can pick either one, but you can't go backwards and get the rate that used to be. So knowing that, we believe that there's a very strong probability that the rate today is going to be a lot better than the rate that they may be crying like a baby over 3.25, how ugly it is, but believe me, they will be begging for 3.25 come this summer. So it's a few months away. They'll be begging for 3.25 and they won't be able to get it. So what we have to do is we have to explain that to them and see the future and explain the future before it becomes obvious. Now notice in the fall, they're going to cycle back down. We believe that there's really good reason to believe that they'll come back down in the fall, but then they could potentially get a lot better in 2022, 2023, when inflation slows down, when economic activity slows down, and when there really appears to be signs of a recession that we'd already be in if it weren't for all this artificial stimulus that we've got. Now, the inflation is going to be transitory, like we said, and this is an interesting way to view this. People don't go this wonky or this deep, but follow me because I think you'll find it makes a lot of sense. The all-in unemployment rate is 11%. Forget the 6% that you're seeing. This is people that wish they could work full-time, but they got to work part-time. People that aren't being accounted for because they're discouraged or they haven't looked for a job in the last 4 weeks. If you really take a look at the unemployment rate, it's 11%. And it's important to look at that because inflation from the labor market accounts for 75% of all inflation. Now, a big portion of the other parts of inflation come from capacity. Think about it like this. When you guys were like at crazy capacity levels and you guys couldn't even breathe, margins tend to expand. When mortgage companies are slower, margins contract. So that's capacity utilization. So the factories in the United States are only at 74% capacity. So they don't really have a lot of pricing power because if I try and raise prices, you'll go to somebody else who will take you on as a customer gladly. In fact, you're seeing a lot of discounts where people say, hey, look, I got a factory. It's open here. We need the work. Send it our way. We'll give you a break. Normal capacity is 78%, and you don't start to see inflation until you get in the 82, 84% range. But when we look at the ratio between these two, which a lot of people don't do, and I want to show you an interesting formula here. If you take the capacity utilization and divide it by the employment rate, so you take 74 divided by 11, the ratio of the employment rate to the capacity utilization rate is 6.7 times. Normal is 8. During COVID, it was 11. That was when inflation was at 2%. So we think that the economy is much weaker than people are estimating. We think inflation is much less than what people are estimating. And unless the unemployment rate drops dramatically, which we don't see, or factory capacity rises significantly, which we don't see, this inflation is going to be transitory. It'll be temporary. And that means rates will cycle back down. Now, here's something that a lot of people are struggling with, and you should use these charts. And this shows mortgage rates for the past 40 years in blue and the Fed funds rate in red. And what I want you to notice is not just that 40 years ago, we were 18% mortgage rates, but what I want you to notice is the relationship between the two isn't in lockstep. You get a lot of times where the Fed funds rate goes up, mortgage rates go down. That's because it's perceived the Fed's fighting inflation, mortgage rates like that. Or the Fed funds rate goes down, loose on inflation, mortgage rates go up. And you see this pattern over and over and over. But notice even here, when the Fed was like they were for 7 years at 0. Now the Fed's at 0 today. So people say, hey, wait a minute, the Fed's at 0. How can mortgage rates go up? Well, if you remember, I showed this chart quite a bit at the end of last year, and I said we're about to go through one of those periods. And here's a couple of them. Well, the Fed was at 0 here. In 3 months, we went from 4 1/8 to 5 1/8, up 1%. In about 5 months here, we went from 3.5 to 4 3/4. And this was a pretty big move at the time that you might remember. And we see it over and over again, but we're about to go through one of them now. While the Fed's at 0, we've seen mortgage rates go from, let's call it 2 3/4 to 3.5, 3 1/4, but it'll probably, before it's over in the next few months, go to 3.5 or 3 3/4. So in about a 5 or 6 month period, we'll likely see that 1% bump like we've seen before in mortgage rates, even with the Fed at 0. So this is coming, and you have access to this. And look, team, when I spoke to you in 2019, I know everybody thought I was nuts for some of the calls we're making, but I'm bringing you behind the curtain. I'm showing you all the things we look at so that you could see these models work. And I remember when I went on Fox, I went on CNBC and Fox on a lot of them because everybody brought me back after saying, okay, Barry, you were right. Treasuries went to 1%. Where are they going now? And when I pulled up this one, because if you pull up the clip, they said, when I said they're going to 0.5%, nobody believed me. One guy yelled at me and said, I want to debate you. That'll never happen. You're crazy. Pull up the clip. And sure enough, it went to exactly. This is the all-time low of 0.5%. So we dialed it in exactly. I bring this up to show you because this type of logic works. And most people don't see it. Most people don't realize the impact that debt has and the factors that we use, these formulas that we use to determine where we're going. Could it be that it doesn't work this time? It could be. Nothing's guaranteed. But I will tell you that I'm confident that in the absence of stimulus, that we're going to probably see a really meaningful drop in interest rates. I don't know we had all-time lows or not. I'm not saying we do or we don't. But again, these 3% rates are planting tomorrow's refinances is really what they are. You should come back down below 3%. That's probably a very likely scenario for us. So still, I would think about today, maybe don't do upfront MI, do monthly to the extent you can. Don't do points, do 0 points. And if you can reduce fees and take a higher rate in exchange for that, I think it's a smart move. And you really need to use debt consolidation, team. This is really the golden goose right now. You know, like any good football coach or any good quarterback, they're going to say, hey, let's take what the defense gives us. And what the defense is giving us right now, one of the points of friction is that rates have gone up a little bit, and a lot of your competitors out there are not realizing the opportunity that exists by using debt consolidation. You know, you have these tools at MBS Highway. So refinancing in a higher rate market, let's use a hypothetical scenario. Let's just say somebody had a rate of 3% and they bought a home with an 80 LTV. So 3% and no MI. Now, over time, their home appreciated naturally and their loan balance amortized naturally. So they've got some equity in the home, like most people do. Most people have over $200,000 in equity. The average LTV is 51. Pretty crazy, right? So they've got equity, but they are in an environment where they look at the current interest rate environment. Let's just say rates are 1% higher, 4%. And let's even throw in some expensive closing costs and say they're $4,000 for closing costs. Now, remember, you shouldn't include prepaids and escrows in closing costs, but even outside of prepaids and escrows, they're $4,000. So we look at this and the normal loan originator would say, why should I bother that customer and ask if they wanted to refinance? Because it just doesn't make sense. I'm not even going to call them because their payment's going to go up $116 a month and they got to pay $4,000. It doesn't seem that it makes sense. I'm not even going to contact them. But if they did contact them, as we've talked about in the past, they're going to discover that that family has debt, maybe 20,000 credit cards, Best Buy, Macy's, modest car loan for a Chevy, and maybe they've got alimony. And when we look at it, we put it into the debt consolidation tool that you all have access to. Then what you're able to see is that by taking their loan amount and increasing it to cover closing costs by $4,000, their LTVs now is 60. When they bought the home at an 80, amortization and appreciation has brought it to a 60. I can no brainer do this at a 75. So you got all this space here, which is translated for you to $91,000. So if we use this 91,000 to pay off the debt, increase the loan amount, what would that do to payment? And in this particular real live scenario, it's $1,800 about. Now that's great, but we can also look at things like, hey, you've got a little bit more room here. You still got $30,000. What if we took that $30,000 and used half of it to do your bathroom with some debt consolidation? And now instead of saving $30,000, we're saving, instead of saving $1,800 a month, we're saving $1,700 a month. And instead of having $30,000 left, you still have $15,000 left, but we're not going to use it. Now, $1,700 a month, it's a lot of money every month to save. And they could put that in their pocket, but let's face it, their ratios are low. So it's not like they're struggling to make the payments. They can handle their overall indebtedness of $5,000 a month without too much of a problem. So when we think about it, we say, you know what if we reduce the term of your mortgage and reduce it so that you're paying the exact same thing you're paying now, you're easily able to afford that. What would that do to reduce your term? It's going to reduce it a lot and it'll even bring your interest rate down a lot because your term's less. But if we wanted to even give you the option to voluntarily pay the $1,700 a month, we keep it at a 30-year fix at the higher rate of 4%. But what would that do if we applied this all towards principal? And the answer is interesting. It would take your current balance, which is 26 years and 10 months, and cut it by more than half. You'll only have 12 years and 5 months worth of mortgage. So instead of 322 payments of that $5,100 a month, you'd have 149. So we're going to save you 173 payments. Guys, it's the best retirement plan in the world to know that you've got essentially $5,000 a month coming in for the next 173 months. This is something that is life-changing for the customer. And you don't have to wait the full 12 years and 5 months. Look, even just 5 years down the road, if you hang up the phone, you don't do anything, you'd amortize $48,900, let's call it $49,000. But instead here you'd amortize, if you do it this way, you pay the same amount of money. You just let AmeriFirst do it for you in a smarter way. And now you benefit by $107,000 guaranteed and tax-free. Doesn't matter what the stock market, bond market, Bitcoin, that doesn't matter what it does. You just make the mortgage payment. You got an extra $107,000 tax-free in 5 years. In 10 years, you got an extra 241. And 12 years and 5 months from now, when this thing's paid off, you benefited by an extra $317,000. So we got your retirement already set for the next 15 years after that. And you could use this for anything you want, including your kid's college education. You got a 3-year-old beautiful child there. Maybe it might be a good idea to do this, because by keeping your payment exactly the same, nothing's changed. You got your retirement and your kid's college taken care of. Wow, that's pretty life-changing. The only thing that did change, though, is while their payment's the same, now you included their bathroom in there. So they've got a home that's worth more enjoyment every single day, kids' college taken care of, and their retirement taken care of. Their payment didn't change $1. This is what an advisor does, team. This is what we have to do. Look, folks, let's understand this. There's no way we're going to win a price war. No way. And there's no way we're going to win a war by saying that we can do something faster than you. Moore's law and technology, we know the way it's moving. Okay, it's all going to be faster and faster and faster. There's no way we're going to win this. Where do we win? We win by being smarter than our competition. We win by providing better advice. We win by making the best investment you can. People say, Barry, you're so in touch with the markets. Where should I invest? I'd say, here's where you invest. You invest in your brain. That's it. That's what you need to invest in. That's the best investment in the world. Because if we do that and we practice and we know how to articulate it, our tools, what's the tools that we have? The tools that we have are our words. That's it, guys, gals. It's our words. That's our tools. So how do we best advise and communicate that advice to the customer? That's what we need to be working on. That's our best way to ensure success, protect our business and our families from, others coming in and trying to put their footprint in, like fintech. This is the best way we could do it, because that's something that people will always want. My landscaper, he had Lyme disease. It's a real life scenario. I helped Gary out. The guy was living off his credit cards, $27,000 a month. I didn't do the loan. My daughter Nicole did it because she's a friend of the family's with Gary as well. And we increased his loan amount, paid off all his debt, saved him $26,000 a month, and then said, Gary, the $26,000, take $10,000 a month and just blow it and enjoy your life now that you're healthy. But the other 16 you're never going to see, because Nicole built it into the mortgage, and Gary's paid his loan off in 2 years and 2 months with $465,000. I mean, this is what you get to do every day. You get to do this every day. So interesting, because Gary got emotional, his wife got emotional, but his son drove to my house and thanked me for changing his family life. And now his son Garrett works for us, because what he wants to do is he wants to take this and help everybody else with it. It's so great. You guys get to do that every day. All right, let's talk about housing a little bit here, because housing is really important, but it's not without its challenges. And we've been telling you for a long time how hot the housing market is, and you've seen us talk about this chart. The reason why you've seen me talk about this chart for the last 15 years and continuously update it is because it works. This is how many people are born every year. It's so funny. Like 2 weeks ago, I saw somebody on Housing Wire for the first time talk about demographics like this. They're like, oh, so now you finally got it. Yeah, this stuff works. It's accurate. So what this tells you is every year how many people were born in the US. And Zillow tells us that the median age of a first-time home buyer is 33. So in 2020, that 33-year-old was born right here in 1987. And what I want you to see is what's about to happen, because the person born here is your median age first-time home buyer in 2021, 2, 3, 4, 25. Look at the next 5 years. Notice something? There's an explosion in births. That's going to be an explosion in first-time home buyers. It's so important with first-time home buyers because a move-up buyer buys a home, but they also sell a home, so the inventory remains neutral. But a first-time home buyer buys a home and has nothing to sell, so they are depleting inventory. And that's important for us. See, when you look at this chart, you remember we called the stock market crash in 2000, the housing bubble, sorry, in 2006. And I remember going on CNBC and people giving me hate mail and saying, what do you mean, housing market strong? I told people don't do neg am loans and coffee loans, and people hated me. Well, we were right, Because what we did was we looked at this chart, and this chart showed us that birth rates dropped crazy in 1973, and 33 years after that, they were 33-year-old first-time homebuyer in 2006, and there was a lot fewer of them than there were in 2005 and 2004, because this reflects 1972 and 1971's births. And the reason was because abortions were made legal in 1973. The birth rates dropped, they stayed low, then they perked up. And that manifested 33 years later, where you see the blue bar is households being formed. They dropped, went flat, and perked up, just like the birth rates did. And that holds true because that's going to happen because the births occurred, and 33 years later, they're going to be looking to be first-time home buyers or starting a household. But what we're about to see is this explosion, and you haven't seen that yet, but that's what's going to happen to this blue line. It's going to go up, 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 and builders, which are in gold, have not kept up. So the housing bubble started here because builders didn't get the memo, they didn't listen to us, they built homes like crazy, but the amount of households being formed were dropping because abortion was legalized 33 years before. This imbalance, too much product, not enough purchasers, caused the housing bubble. And the hot housing market that you have today is this imbalance. Too many buyers, not enough product. Prices going up. And we know that this is going to get worse. We know that worse or better, depending, but this is going to be more of an imbalance. You're going to have this blue line going up, and the gold bars probably aren't going to keep up because you've had builders never keep up for the last several years. And then COVID hit. And when COVID hit, there's a direct correlation. Much fewer product on the market, home price appreciation accelerated, bid over ask accelerated, much more difficulty finding a home. The housing market got really hot because there was no product out there. And we're exacerbating this with vacancies. Vacancies are at an all-time low, which means people don't have the incentive to say, hey, you know what? I'm carrying this home. There's nobody in it. I'll just dump it because of the carrying costs. No, there are no vacancies. So silly to hear people talk about the housing bubble now and say, there's another bubble brewing because prices are going up. That's not why bubbles occur. Bubbles don't occur because prices go up. Bubbles occur because there's an imbalance. And the imbalance that we're seeing is nothing like it was in 2007 when there was 3.7 million homes for sale, or in the mid 80s when there was a ton of homes for sale. Now, this is actually reduced from the end of 2020. It's already 1.02 million, so it's already dropping. So this drop in the amount of homes that are available or inventory that's available, it's very, very thin. I mean, let's look at it this way. In 2007, there were 116 million homes for sale. I'm sorry, forgive me, 116 million households. In 2020, there's 128 million households. So there's 12 million more households, but there's 3 million fewer homes. That's why you're seeing these struggles here. And some people talk about forbearance. They say, forbearance. Well, forbearance, as you know, it means you paused your payments. Now, when we come out of forbearance, it's true you have to resume your payments. And a lot of people went into forbearance that didn't need it, so they'll be fine. Most people got their jobs back. They'll be fine or never lost their jobs. But there is a small segment that have lost their jobs and that will have to figure out a way to make it work. But if they can't, the silver lining is that if they put their home on the market, A, they have equity to protect, B, the home will sell very quickly, and they'll probably be okay. And it's a very small segment because COVID disproportionately adversely affected renters by 4-to-1 over homeowners. Now, the amount that you put in forbearance, you don't have to pay it until you sell your home or refinance. So that goes without any payments, without any interest, and rides along like a second mortgage until you sell or refinance your home. So the equity should cover that. The staggered nature of it and the starvation that we're in for inventory should allow the housing market to easily absorb it without any adverse effect. Now, I talked about equity. There's a lot. There's 87% of homes below an 80 LTV, 95% below a 90, 37% of homes are free and clear. This is nothing like in 2009, folks, when 26% of homes were much more than the value of the home itself. So we're in a much stronger position. And affordability is one that the media gets wrong. And let's understand this. We just got the report last week that said the median home price was up 16%. And hourly earnings are only up 5%. So right away, Diana Olick says, unsustainable. She's been wrong forever. And all she wants to do is just say bad stuff about housing, and she continues to be wrong. And then Adam Data says last week that housing is miles away from being affordable because the median home price is up 16%, hourly earnings are 5%, and that's unsustainable. Well, let's break this down. So first of all, median home price just simply means exactly that, the median home price. Half the sales above that level, half below. This is being skewed a little higher because there's not inventory on the lower end and there's more inventory on the higher end. Homes over $1 million are up 80% in sales. So we should just look at not the median home price, but real appreciation. We're going to get these numbers next week from, we're going to get them actually this week from Case-Shiller and from FHFA. They give us real appreciation, and they're going to probably be 10% or so. That's real appreciation. Okay, so I get it. Hourly earnings are only up 5%, appreciation of 10. It seems like it's unsustainable or not affordable. But the first step is hourly earnings. What if you work more hours or less hours? The smarter way to look at it, and nobody does, is weekly earnings, and they're up 6%. Now I get it. Somebody could say, hey, wait, 10% appreciation, 6% weekly earnings. It seems on the surface that it's less affordable. Well, let's get this down. It's hard because it's math, and sometimes you got to dig a little deeper than the surface, and let's do that. So assume a year ago, a home was $1,000 a month for the principal and interest payment. If that's just principal and interest, their income, round numbers, would need to be in the range of $5,000. Now this year, even though interest rates are a little cheaper than they were last year, let's just say they're around the same, but the home value went up 10%. That's real appreciation. So if interest rates are about the same on the mortgage, that means their payment will go up 10%. So a 10% rise in price would cause the monthly payment to go from $1,000 last year for that home to, on the same home, $1,100. So it's up $100 a month. On the surface, you might say we're less affordable. Except, what if your income went up? Well, if my income goes up $100 a month, it's just as affordable as it was last year. I've offset it. But this is not a 10% rise in income to offset a 10% rise in price. You probably could do the math in your head. This is only a 2% rise in income. So if a 2% rise in income can offset a 10% rise in price, and we're going up 6% in income now, we could see prices rise 20% and they'd be more affordable, not less affordable. Sure, we got to consider changes in interest rates, but more than a 10% rise is easily handled and making the market more affordable. This is the 7th most affordable market in history. Now, last year, a home for $300,000 that went up 10% would sell for $330,000 this year. So is this home less affordable because it's $330,000? Let's go through it. If somebody went for a 90 LTV, they borrowed $270,000 last year, but this year they got to borrow $297,000. So they got to borrow more money. And with the change in interest, let's say 3 3/4 this year. Last year at this time, 3 3/8 this year. Last year it was 3 3/4. This year, 3 3/8. The payment would still go up because you're borrowing more by $63. And there's more MI that you got to account for by $10. So, hey, it's less affordable by $73 a month. But let's look at the income. That income went from $5,000 to $5,300. So I'm making $300 a month more. I only need to use $73 of it for the increase in home prices. So believe it or not, it's crazy it sounds, last year this home selling for $300 was less affordable than it's selling for $330 this year. It's more affordable this year at $330 than it was last year at $300. Is this a good time to buy? Heck yeah. Rates remain very favorable if you can get the home, if you can win the home. High demand and tight supply are telling us now, we put in our official forecast for 2021. Let's see if we have another crystal ball in our future, but our forecast for 2021 is telling us between 7.5% and 8.5% appreciation. But even just 7.5%, if we think about it, on a $100,000 home, to use an example, the return on our investment is pretty darn outstanding. It's not 7.5% because if you put 10% down, your down payment is $10,000. So $10,000 down payment on a $100,000 home, but that home went up 7.5%, so it went up $7,500. $7,500 profit on a $10,000 investment. That's a 75% rate of return on my money. Wow. Team, let's take a look here at one of the big friction points that's out there, and that's winning the home in having to bid over asking price. It seems like today you got to win the home. You can't just buy it, right? And we're going up against a lot of cash offers. The existing home sales report showed 22% of closings were cash. That means that probably 25, 28% of offers are cash offers that you're going up against. That's tough sledding. How do we do it? You got to get the seller to understand that, sure, you have the certainty of a cash offer, but if you have a very qualified buyer and that buyer is willing to give you more money, there comes a point where you will leave the cash offer and take the offer with a mortgage from one of you folks' clients. Now, here's a real life example. It's a home in California for the zip code 91901, and it was listed for $900,000. There's cash offers, there's full price offers, there's over asking price offers. And in order to win this home, this guy had to come in $40,000 over asking at $940,000. That's a lot. Does it make sense to do that? Well, that's why we use the bid over ask tool in MBS Highway. So the first thing is they use the MB estimate to get their AVM valuation. You don't want to go to Zillow because they're going to pixel you, and that means they're going to market to you consistently. This 912 AVM meant that, look, it was more than what it was being offered at, but we were going to offer much more than that. So here's the question that the buyer really needs answered for them is, when in the future will the value of the home be greater than its current value and be at least what I paid for it or more? And we'll give you that answer. In this zip code with the appreciation, it would take 5 months to get there. So the buyer was like, hey, 2 months after I close, that means there's only 3 months left. I'm sorry, 2 months until I close, and 3 months after I close, that's 5 months total. You're saying 3 months after I close, that home will be worth more than what I paid at $940,000? Yeah, that's easy. And it sure doesn't hurt to know that over the next 5 years, that home's going to appreciate by $247,000. Now, this is a tool that's the answer to every realtor's prayers right now. When you have the gold, everybody wants it. And this is the gold right now. And it also helps to evaluate it. What if this was 5 years or 8 years? At least you have a way of figuring it out. Now, listen, I don't want to be insensitive to the fact that when you bid over asking, you bring in and introduce some additional potential concerns. Will it appraise? If it won't appraise, will it affect the LTV? Will they need MI now? These are things we have to contemplate, certainly, but you have to start somewhere, and this at least gives you a way to better navigate rather than just playing a guessing game or losing the transaction. And people from all over are writing in with unbelievable success. Here's one where they put the CMA on their license plate, Jonathan did. And he said, I used the bid over ask tool to get a buyer to go 10K over asking on a 255 purchase. They were lowballing everything prior to this report. Now we have an accepted offer. So here's another one where they wanted to cancel because they keep hearing negativity in the media. And they said that, the media was talking about a terrible time to buy, but they sent one of the appreciation reports, how to talk with his wife, showed her the email with the appreciation, the equity in the home going up. She finally got it, sent the realtor an email not to cancel, and we're moving forward. And then I like this one, in the past 2 weeks, 8 pre-approvals, 4 purchases using these tools. But I've had 2 realtors reach out to me and say, another agent in my office works with you. I'd like to have coffee and talk about how we can work together. One of these had an in-house preferred lender. Team, it's so nice, as I mentioned, when you have the gold, everybody wants it. And it's so nice that realtors have this point of friction right now for us, because if we can help them with it, they want to gravitate towards you. And that's where you should be. We're not going to win the rate wars. We're not going to win the speed wars. But if we can do things that help articulate the opportunity by using our brain, by using the tools that we have at MBS Highway, the great company and leadership that you have, you've got everything that you need to continue to win. And the MB estimate is an easy tool, so please familiarize yourself with it. And you can take that tool. There's a tiny charge for this if you wanted to do it additional. It's very small, but you could take it and put it on your website to generate traffic, or you can co-brand it with your realtor and put it on your realtor's website. And then that's really owning that relationship. So just think about that. It's $10 a month for each of you and your realtor. It's not going to break any piggy banks, trust me. And then use the it's within the open house, or you could use it individually, but the cost of waiting. A lot of buyers are discouraged. They're looking for a home. They can't find something because it's hard. And they say, maybe I'll come back in 6 months. That's heartbreaking for the realtor. Cost of waiting keeps them in the game because they'll see if they wait 6 months, it will be much more expensive. So let's stay at it now. And then team, Social Studio, you have all these tools. I'm just bringing them up to remind you, but you need to get on the web. You need to be doing videos. You need to get it out there. You need to get messages out there, and we do it all for you. Just read the script for 30 or 40 seconds. You got it. People are having enormous success with this. So please just use the tools that you already have. Make sure you're watching the daily update every day. I know you guys are smart, and I know you're also busy, but that 5 or 6 minutes will really, really help you to get your message across. Remember, if truly, if you do believe what I'm saying, that your tools are your words, then there's no better way to sharpen those than watch that daily update and really focus. And so that you can reiterate those points and be smarter than your competition and be a better advisor. You should be using the real estate report card with every single customer because this will really help. And it helps the real estate agent too, to keep that customer to see that great opportunity that's out there. And then what you also have here is you have the debt consolidation, which we discussed and we talked about. You have the cost of waiting, which we talked about, the buy versus rent. And please use all the tools that you have. Like, for example, you have that situation where you've given that customer quite a few different loan options. And the customer's like, okay, I'm a little dizzy from all these options, or different down payments, or different repayment terms, or conventional, or what's the best mortgage for me? Is all they want to know. And the truth is that many different options could be the best. What you have to know is time frame. And that's why when we came up with this, so that you could describe this along a time frame, the buyer finally gets it. They say, oh, so you're telling me that within the first 3 years, this is the cheapest. And then the next 3 years, this loan's the cheapest. And then after 6 years, this loan's the cheapest. I get it. And you could uncheck these and it'll change dynamically. This is the way you want to give a presentation, because let's face it, when you're dealing with someone who's trying to present something to you, the more clarity and the easier you can understand them and connect with them, the more you're going to gravitate towards working with them. This just allows you to connect better. And that's what will help a lot more people want to do business with you. And I mentioned Social Studio, and you've got a screen share and a screen record. SurveyMonkey survey independently said people that use these tools made an extra $35,000 in the first 90 days by just using them. So many of you are using these tools and you're doing such a good job. But in case you were just a little too busy, please refocus and do it. And when I talk about focus and working on your business, it's different than working in your business. Look, you could be really successful in this marketplace. You just have to change your focus. And I put this in my book, Craig. I put this in my book about one of my lessons from the track. I do like to drive on the track, but like with everything I do, look, team, I eat my own home cooking here. I'm talking to you about investing in your brain and investing in your skill set. With everything I do, this is just what I truly believe in. So if I'm going to drive a car on the track, I want to be really good at it. I don't want to be nilly-willy on it. So I've spent a lot of time with professional drivers who have spent the whole day instructing me. And one lesson was very meaningful where the instructor said to me, Barry, I noticed you, like almost everybody else, you tend to look at the car in front of you. And I kind of said, like, I guess. And he said, listen, Barry, here's what we're going to do. We're going to pull over. So he made me pull over to the side of the road, and he made me grab my bottle of water and take my bottle of water out. And he said, okay, Barry, what I want you to do is I want you to take your bottle of water and I want you to put it down, and let's step back about 20 feet. And he says, okay, now Barry, look at the bottle of water and tell me, can you read that sign up ahead? And I said, no. He says, okay, look at that sign up ahead. Can you still see the bottle of water? I said, yeah. He said, you can read that sign, right? I said, yeah. He said, you see, Barry, that's why you don't want to look at the car in front of you. What you want to do is you want to look much further down the road, because if you do, you'll still be able to see the car in front of you, but now you can better position yourself on the track. He said, but what you really can do is use that when you go home and protect you and your family better, because that'll make you a much better driver in general. You see, most people, if you look at them when they're driving, they'll watch the car in front of them, but that means you got to depend on the driver in front of you's reaction time. Because if you look further down the road, you can still see the car in front of you. But if you train yourself to do that, you can see, heaven forbid, bad things happen a lot earlier and be much safer and protect yourself much earlier. You don't have to react based on their reaction time. You'll see it before even they do. And I thought about in life, isn't this really what we have to do? In business, isn't this really what we have to do? Look further down the road. focus further down the road, and see things before they become obvious. We see these changes occurring. We can give better advice. We can alleviate these points of friction. We just have to work on our business instead of in our business. People that don't want to work on their business, they oftentimes say, it's because I'm too busy. If you're too busy, I get it. But man, look at McDonald's in 1955. They were a tremendous burger shop. And if they would have just stayed working in their business, they'd still have a great burger shop, I'm sure. But by Ray Kroc telling them to work on their business, they were able to build an empire. And that's my wish for you, is for you guys to build an empire. And I know that you can do it with the team that you guys have. So thanks so much, guys.
Wow, I'm speechless, Barry. As usual, we asked, you answered, delivered. That was an hour of incredible power. I will share with you that Brian Maddox has mastered the MBS platform and closed over $100 million in business last year, over doubling his production, and just amazing hard work. Michelle Zelvis chimed in here on the Q&A chat, says, I got my CMA this year. Thank you so much. I've used the tools and totally blew my competition out of the game. So Barry, I want to ask you. We've got a number of certified mortgage advisors. Your platform that you introduced about 6-8 months ago. However, we've got a number of people that paid for it and didn't take the time to finish it. I'd like you to speak to them, and then also we've added a number of other LOs, and give us just a quick, and man, the minutes just kept going. I kept going, man, this time's flying by too fast. I don't want this hour to end. But so just give us a little snippet of tell why those people that paid for it need to finish it, especially in times like this, and then what it is for those new people and how they might be able to get involved.
So many people have told us after going through it that it has been extraordinarily meaningful and learned more in that period of time than they have in 20 years about the mortgage industry and how to better position themselves as an advisor. I'm sensitive to the fact that time is at a premium. I'm very sensitive to that. I struggle with it all the time. But that's why we decided to make this course. It's 8 hours. We could have probably made it 20 hours. By the way, all your continuing education is also in there too. So you don't have to pay for that continuing. It's all in there for your NMLS. However, we did 20-minute modules so you could take it a bit at a time. Now, maybe you don't have 8 hours today to go through it, but you probably have 20 minutes today that you could do it. And if you don't have it today, certainly between today and tomorrow, you definitely can find 20 minutes to do it. And if you approach it that way and you say, look, I'm going to do 20 minutes a day, it doesn't seem like it's that overwhelming, right? Especially if you know that this is going to be helping your career and you know it's going to be increasing business, because after all, that's what you're so busy trying to do. You don't have the time because you're figuring, I'm trying to do all this. That's the classic working in your business. This 20, 40 minutes, maybe you do 2 modules a day of working on your business will allow you to achieve the goals that you ultimately want to do. And please see the future before it becomes obvious. You know what fintech's doing. You know all these companies that have been going to the public markets. Heck, since when did the Super Bowl become a mortgage event? It's 3 companies advertise. Remember when we got in this business, many of us, it was the best kept secret in the world, right? Nobody knew. Now it's like everywhere. So you see where this is going. You're smart. You know this, okay? You don't have to wait till the credits roll on the movie to know the plot, okay? What do we have to do? We have to be smarter and raise our game, and you should be doing it before others do. So those of you that were kind enough, smart enough, and wanted to invest in yourself, and you have the heart already that you did it, see it through, because you'll reap the rewards. And if you haven't done so already, you may want to consider it, because your company is doing so much for you on your behalf. Do this for yourself, do this for your family, do this for your long-term career, because you have to stay above your competitors. Don't let yourself go by the way of the travel agent. We've talked about that in the past. But how about the cab drivers? How about the stockbrokers who really got decimated? In every situation, what wins is knowledge. What wins is advice. What wins is people that invested in themselves to make themselves worth more. So you have a chance to do that every single day. And I want to say one other thing, is that while we definitely need goals that are financially driven, while we definitely need goals that are achievement driven, we need that. You see people that have a lot of achievement and a lot of money that they made, but they're not happy. And that's because they're missing fulfillment. If you're an advisor and you're not just taking loan applications, but you're really doing them in a way that helps people change their life, that gives you fulfillment. So you hit your success goals, you hit your achievement goals, but you're doing so in a way that you feel so good about helping those individuals along the way and changing their lives for the better with your knowledge, because you did that and your competitors won't be able to do that. That gives you fulfillment. That makes us happier. And that's what I want for you guys. I want you guys to have that. I want you to reach forward for your goals, but reach back so you can bring somebody along and help them too. That's what makes you guys not get burnt out, feel really good about what you're doing, gives you more energy, and quite honestly, makes you magnetic. And people will just be attracted to you even more, because being magnetic means everybody you come into contact with, you make them feel better, you make them feel smarter. So if you pour into yourself, you have something to give to pour into others. So please, I know that time's precious and I know it's at a premium, but take those bite-sized pieces, and it's not time spent, it's truly time invested.
That's great stuff, Barry, really. We've got 5 or 6 questions, but quite honestly, you've answered all of them throughout your presentation. So R. Simmons, if you could send me some more details on who you are, what you've got. I don't recognize the name. We've got some books to hand out, but I'd like to take the next 4 or 5 minutes. Barry, are you okay for 4 or 5 minutes?
Yes, sir.
Thank you. I'd like to bring the rest of the panelists in and just kind of wrap up their thoughts. Doug, Ron, Mark, if you guys are still out there, jump on in, and would love your thoughts on what you just heard over the last 60 minutes. Doug?
Well, I would say that if anybody doesn't understand how to become a certified mortgage professional, we're going to be competing against potentially AI and robo LOs or whatever. Guys, this is a human business, and you've got to be the best human and the biggest human decision people make in their financial careers. And Barry has every tool available for you. I got to tell you, it's just every time I watch you, Barry, and I see those tools, I sit there and go, man, I wish every one of our loan officers were sending out that report card on every pre-qual, making sure that the bid over ask, holy crap. I mean, good grief, what all the inventory issues we got today, that's the best strategy I saw. Oh my gosh. And it takes the emotion out and puts the financial reason why. And so that's Barry, as always, killed it. Thank you, sir.
Thank you so much, my friend. Thank
Ron
you.
Burgum.
Yeah.
Oh, look at that.
I don't know. Got some books here.
Thanks, Ron.
I'm just saying. I just say drop that mic, dude. That was sick. That whole presentation. We were talking about our readiness call last Thursday. One of the comments that Doug and I were talking about before we got on, and we said work on your business. I mean, we pivoted. We see that, obviously the market's been awesome. We saw the pivot happen, the rates movement you just showed everybody. And our focus has been for the last, solid 6 weeks, working on your business. And I didn't know you were going to talk about that today, but here we are.
Great minds think alike.
We're aligned, Barry. We're aligned. Thank you so much for making a great training meeting for us today, which was unbelievable. If you don't know what to do, the way you hit that outlined things you must do, highlights of the MBS Highway, phenomenal. I love you, buddy. As always,
you too, brother. I love all you guys. Thank
Garb?
you.
I was listening. Yeah, I was listening to this thing from a perspective of a real estate agent, and there's so many that are stuck out there. They're just stuck, and I think what you said is going to help a lot of real estate agents to say, wow, I can actually go out there with a different mentality. So it goes back to great mortgage professionals being great consultants to both the consumer but to real estate folks. And so it was great. Thank you so much.
Thank you.
Mark.
There's an old story about seagulls in Lake Michigan, because we live up in Michigan, obviously, and they dredged out for a bridge, and they put a big pile of junk on the seashore, the lake shore. All the seagulls just feasted on the big pile of crap for a year, and after that, a lot of them died because they forgot how to fish. And in our industry, that's the danger of a refi boom. I mean, you look at the folks that go out there and the new folks that come in, and all of them are feasting off of that big, huge largesse that we've all experienced. But to keep our team focused on how to fish and to make sure that they don't lose those skill sets during those times is really imperative. And to have this kind of a refresher, particularly what we're going into, because it's coming. Those people that don't know how to fish, they're going to fish the only way they can by crazy lowering their rates. So to have you in our corner and to constantly remind our people how to fish and how to bring value and how to partner, and to Doug's point, the most human company wins. And with your teaching our folks how to do this, we've got the best trained sales team out there right now, and I'm so excited. You're a big part of it. Thank you, and congratulations on all your success. Loved your book. It really is well done. So thank you.
Gosh, thank you, guys. I'm so proud to be affiliated and friends with you guys, and just it's you guys are everything good about this industry. So thank you. Thanks for allowing me to call you my good friends. Thank you.
Yeah, we appreciate you very, very much. There is one question I do have that I want to read. Can we get a copy of that deck that we saw today?
The copy of the what?
The slide deck, the PowerPoint.
Most of it's already in MBS Highway. If you go to Presentation Expressway, you'll see most of it's already in there. It's already there for you. Just go to Presentation Expressway.
Awesome. Thank you, my friend. Really appreciate you joining us. Appreciate what's now 72 minutes of just incredible value and information for you to take away. So with that said, we'll wrap up today. See you tomorrow for the readiness briefing at 11 o'clock Eastern. Until then, be smart, be safe, and have a great day, everybody. Take care.